everyone, my name's Jen. Welcome back to my channel where I talk about everything money, business and investing. Today I'm going to talk to you about how I calculate the return on investment and cash flow on a residential rental property. So I've done the figures based on a investment property in Nelson, New Zealand, which is a region at the top of the South Island. Generally, you can pick up a rental property here for under $700,000 still. I've based this on a property purchase for $540,000 and I've built in different scenarios into my spreadsheet. Okay, so as you can see, I've got 3 different columns and each one is based on a different rental amount per week. I've kept the property purchase price and deposit required the same. So this is based on interest only and a deposit amount of 30%. I've also based it on a mortgage interest rate of 7%, which is the average in New Zealand in the last 10 years. I've assumed my insurance is going to cost me $2,500. My rates are going to cost me $3,500, and I'm going to pay 8% in property manager fees, and I'm going to have $1,000 in R&M every year. So if this property was able to return $600 a week, which, to be honest, for this particular property, the amount I'm probably looking at realistically is $550 a week. But say it can achieve $600 a week. I am going to have rental income of $31,200, and based on my yearly costs of almost $36,000, I'm actually going to have negative cash flow based on me paying interest only of $4,756 a year. So is this a bad investment? Not necessarily, because the average increase in value for the Nelson region across over the last 10 years has been 6.5%. So based on a purchase price of $540,000, if we get a 6.5% increase in value, it's going to increase in value in the first year by just over $35,000. If we take off that first year cash flow loss, you're going to get a net gain of just over $30,000 in the first year. More realistically, that property is going to achieve $550 a week rent, so $28,600 a year. My costs stay relatively the same because the interest rate is the same, 7%, insurance rates and maintenance doesn't change, it's just the property manager fees change based on the weekly rental amount. So when I take the costs off the rent, I get a loss again of $7,148. So again, is this a bad investment? Not necessarily, because you still have that capital gain of $35,100, giving you a net gain of almost $28,000. In New Zealand, if you hold on to a investment property for longer than 2 years, you do not have to pay any tax on that capital gain. So that is a massive perk of property investing in New Zealand. Down here, I've calculated the net rental yield, which is the profit and loss here divided by the property purchase price. So these are all negative, obviously, because the cash flow in year 1 is negative. It will continue being negative if we keep on interest only, and if the rental amount achieved per week doesn't go up, then we're going to keep seeing a negative cash flow year on year. But the benefit of property is in the capital gain, which is tax-free if you hold the property for more than 2 years. So let's calculate the yield if we include the capital gain. So this is based on the purchase price. So what I have done, I've calculated the net gain. So I've taken the capital growth in year 1, taken off my cash flow loss, I'm going to get a net gain of $30,344 based on the rental amount of $600 a week, or just under $28,000 if we charge $550 a week. That's going to give me a yield of just over 5%. This might seem low compared to if you say, oh, but I can achieve 6% if I put the money in a high interest savings account in the bank. Well, yes, you can. But the benefit of property investment is leverage and the fact you can borrow money from the bank. So we haven't, that 540 that we've paid for the property, that isn't all our own money, is it? We've actually only invested $162,000 of our own money. We've borrowed $378,000 from the bank. So if we look at it in real terms, which I think is actually this yield figure here, which includes the capital gain, and it's based on the amount that we have invested only, not based on the purchase price of the property. This figure here is the real yield of that property. So if we get $550 rent a week, I've purchased the property for $540,000, but I've only put in 30% of my own money, $162,000. Every year I have to top this property up from my own cash flow, from my own pocket, by just over $7,000, but I am gaining in equity almost $28,000 a year, which again, if you hold that property for longer than 2 years, you hold it as a long-term rental investment, it's going to be a tax-free capital gain. Then your realistic yield is 17% based on the amount you've invested, $162,000, and your net gain a year on that investment is almost $28,000. As always, if you're purchasing a rental property, it is always best to get advice from a lawyer and an accountant, because they're going to take into account your personal circumstances and the tax rules at the time that you're purchasing. Thanks so much for watching, everybody. If you want a copy of my investment return calculator, comment calculator below and I'll send you a message. Please hit the subscribe button for more videos like this, and I'll see you in my next one. Thanks, bye.